Howdy, y'all. It's the week of the Reno Rodeo just beginning, and cheers to the rodeo. Here with your Mortgage Insider update this week, we've got the Fed chairman this last Wednesday coming out with the pause or the skip or not raising interest rates for the first time in 11 cycles, 11 meetings that they've had raising interest rates until this week. So let's check out what the reaction in the markets are. So 2 days after the Fed announced their pause in interest rate hikes, we see mortgage-backed securities today on Friday down after being up yesterday. So we're going to take a look at that. But first, the 10-year Treasury also up 6 basis points as we take a look. Now, that was off from Thursday. We actually had heightened rates up until the actual Fed meeting. A lot of times this happens in anticipation of what they might say. And things were relatively calm the day on Wednesday, the 14th, when they came out. Really pulled back yesterday, the 10-year Treasury dropping, and then today coming back up. So we're definitely off the highs, but we're not coming close to the lows quite yet. Now we'll check out the mortgage-backed security pricing. Now these bonds sell to investors, and as the investor pays a higher price, the interest rate to the consumer goes down. So if we can see from back in April, the price has actually dropped, so it's gotten cheaper for the investors to buy the assets, meaning the consumers having to pay a higher rate of interest to get them interested in the bonds. We did hit a low point in the mortgage-backed security pricing on May 26th, and we have improved since then, but have maintained this Fibonacci retracement level, and we're starting to converge, and we can actually see where just in the last couple weeks we had the 200-day, 25-day, 50-day, all the moving averages really converged like right here, and we've maintained a level below that, which is not a great sign. It means interest rates are on the rise. We hopefully can see some light at the end of the tunnel as we start to see the actual data. Inflation reports that have come out very tame this week, giving the Fed the opportunity to pause or skip their rate hikes. First, we got CPI coming in at 4% on the headline. Now that's down substantially. We're seeing substantial drops year over year on these inflation numbers, being that June of last year was the height of the inflation. It's great to see these month over month and year over year drops in inflation. It's not been as significant as you'd like to see. The Federal Reserve has announced they still want to maintain a 2% rate of inflation, so 4% CPI is double the inflation that they're looking for. Hence the reason they're going to pause. They're definitely not lowering rates. And the PPI, or Producer Price Index, came in at, get this, below 2%. So if that's a leading indicator, the producers' inflation on their cost of goods is coming down. So that should lead to consumer prices coming down in the future. We will get the PCE number later this month. We have seen consistent weekly reports from the unemployment claims, first-time unemployment claims coming in still well over 200,000 per week. So that means on a monthly basis, there's at least 1 million people filing for their initial unemployment claims. So that is not indicative of a very healthy employment market. We did see the unemployment rate kick up to just under 4%, 3.7%, still at a historic low. So as the months go on, if inflation continues to calm down, and if we do see those employment numbers, especially on that employment rate, tick up over 4%, close to 5%, that could be a bad thing for the economy, unfortunately, would mean a good thing for interest rates. Have a great week.